Ladies and gentlemen, good morning. As always, we shall start with the shorter end of the American fixed income curve. This is a daily chart of the 5-year yield, and as we suspected, we had the rate hike from the Fed, which was a dovish rate hike really, and we came back into the range, although we were poised to extend the gains in yields. This to us suggests that we have a considerable period in which we will trade between, say, 1.87% and to 10 on the upside, filling these gaps between 190 and 198, and we will probably remain here for an extended period of time, digesting the next move. We've now met the minimum objectives of the 5 wave up, and we could easily now have an ABC retracement which could come all the way back down to 165 in yield over the course of the next few months. We don't anticipate that that will be quick or that it will be decisive. We think we are now in a churn period in the 5-year note. That is also supported by the chart of the 10-year note, which is showing the same pattern. The 10-year has made a double top, and therefore we think being long of the 10-year note and short of the 5-year note is probably the safest position to have in the American market. We think also that the low in yields is going to be caught by this trend line. We don't anticipate yields to fall below the 235 level anytime soon. We need to let this moving average catch up with the price. This is the 200-day moving average, and we will be basing in this area for another try to the upside in several weeks' time. We certainly don't think it's going to be quick. We think it's going to just churn around these levels for the foreseeable future. That is also supported by charts of the IEF, which is the 7 to 10 year area, and ETF, and we think that we are now churning in an area up to 106 and down to 104. So 104, 106 is going to be the trading range for the foreseeable future. In Europe, things are just as uncertain and difficult in terms of fixed income as they are in the States. This is a weekly chart of the Schatz, the 2-year German. It is still very much in a downtrend, even though it's trading at -77 yield. It has much more room to move up towards -62, but that's only 15 basis points in yield different. This structure is still waiting to break the downtrend. We think it is now going to spend a lot of time turning the moving averages to the upside. It is going to take probably several months. The 5-year note, the bobble, is actually, as you can see, tight against the weekly Bollinger Bands. This has turned the moving average to a very shallow uptrend in yields, and you can see how long it has taken to do that. It has taken almost 3 months of price action to turn this moving average slightly, and it will now should push slightly higher with each passing week. But it's a very slow and painful process of basically trading the range, a range which should be from -48 to minus 28. It's going to take several weeks to break out of this range by building up a head of steam to go higher. The same thing can be seen in the Bund, the 10-year. You can see that it's taken almost more than 3 months to turn this this moving average on the Bollingers. It will take several more attempts to have a sustained break higher than this level, which is plus 50 basis points, which seems to be a very good resistance for yields on the upside. So we don't expect much pressure on the German curve to the upside, but we do think that since the 10-year is hard and the 5-year as well are hard against these Bollinger Bands, there is much more room for the 2-year note to weaken than there is for the 5s or 10s. That's why we have short 2-year notes and long 5 and 10-year notes. Again, we think probably the politics will dictate when this move takes place. Don't forget that most people bought the short end of the German curve, and this is this move you see here on a basically panic that the French were going to elect Le Pen. As that panic subsides and the facts come in from the election in France in May, this could very well change, and you will get pressure on the 2-year note as people will no longer be buying it as a flight to safety, and we could see only in May the decisive move higher in yields in the 2-year note. As the yield differentials between the US and the EU are very uncertain, the uncertainty is reflected also in Euro USD. We had a very nice move higher in Euro USD last week. The daily Bollinger Bands are just about keeping it in check. What are the important levels? The important levels are here at 108.27 up to 108.53, where the gap on the daily charts still is back from November. We think that we will at some stage over the course of next week or two fill it. What is interesting is that we have turned the 50-day moving average. We need to turn the 200-day moving average, which we think will catch the price action for the next week. It is at the moment at 109 dead. So we think the upside in Euro USD for next week is caught by 109 to 108.50 area, while the downside is caught by the 50-day moving average around 106.50. That should be the range, barring some external events. The G20 communique, in our mind, is slightly dollar bearish, and we think that we will continue pressuring this 108.50 area, but we think we will probably take out these stops and fail at 108.50 to 109 for some more churn to the downside before we finally try to break this moving average and try to push higher towards 110 and eventually 112, 114. It's going to take some time. It's not going to be quick. It's a question of taking profits and resetting when markets allow. A weekly chart of Euro USD has very much the same picture. We have made a higher low. We are now trying to make a higher high around that 108.50 area that we mentioned. The moving averages are very much in a downtrend. The Bollinger Band comes in at 109.50. So everything basically suggests that the upside is going to be caught at worst by 109.50. And then we should have more retracement towards the 107, churn in this area before we try to make the next move to the upside. In US equities, we still have this divergence between the transports and the S&Ps. The Dow transports are beginning to break down, and after this very clear 5-wave up, beginning to do an ABC, which we think will be caught by this 8,400 area. So not a very deep retracement. We would expect the S&P to come back and trade at least to the 2320 area in the next few weeks. That is also very evident in the dailies. Volatility is extremely low. The Bollinger Bands are coming in and really catching the markets very, very well. We think this is an ABC move higher for another ABC move lower. So we would expect 2337, which is the 0.382 retracement of the third wave, to catch us at some stage over the course of the next week or two. We certainly don't see much upside for the S&P. It is not in a big uptrend. It is not impulsive at the moment. It is much more corrective in its price action. So we think that 2337 at some stage will trade, and we think still put spreads towards the 2340 area are the way to play this. Since we are not that bullish of US equities at the moment, and we think that they are very much exhausted at these levels, let us look at a ratio spread. This is a new chart, weekly ratio spread between the SPY and the FEU. FEU is basically the Stoxx 50 in dollars, and it, as you can see, it has been a very broad uptrend since 2008 and the crash, and accelerated in late 2014 when the dollar started really strengthening, and at the moment, for the first time in several months, it has made a lower high and has broken the uptrend of the ratio between the two. This very much suggests that SPY will be much weaker than FEU, FEU being a combination of the dollar and the Stoxx 50 in Europe. So having seen this, we would guess that this ratio will slowly downtrend towards the long-term uptrend line, but that is a very big move. We are talking about retracing most of the move that happened throughout 2016. We're talking about much lower levels of either SPY or much higher levels of stocks, and a helping hand from the dollar index or from Euro USD. So we are talking about a big move here. This is a move in the order of at least 10 to 20% in the ratio between the indices and or the dollar. So you can see why we are so excited about FEU. We are not talking peanuts of a move here. We're talking in percentage terms, at least 10 to 20% on a relative basis between SPY and FEU. And here we have a weekly chart of the Stoxx cash. This market is now in trend. We are making a new wave up, which will have difficulty breaking this level, which is 3500. That is still a couple of percentage points away from the current price. 3500 is our objective over the course of the next couple of weeks, while the S&P does nothing to retraces 1 or 2%. So we could have a relative move between stocks and S&Ps in the order of 3 or 4% over the next couple of weeks. We are certainly much better buyers of the stocks relative to the S&P, and we look for that trend to continue at least into 3500 over the course of the next couple of weeks. Here we have a weekly chart of FEU. As you can see, it has closed above this very important downtrend line, which has caught it since the highs in 2014. It is for the first time in several years making a pronounced attempt to break and go back and test eventually these levels around 38. That is not going to happen unless it has help from Euro USD, we feel, but we certainly feel that over the course of this year at some stage we will trade 38 in the FEU. This is a very powerful pattern. It'll definitely break higher and test at the very least the 200-week moving average, but we feel that we might easily, very easily trade up to 38 by this time, by the end of the year. There is now the market, by trading in this area between 30 and 32 for such a length of time, has turned all these moving averages. This can be best seen by enlarging this area. You can see how all the moving averages on the weekly chart are concentrated around the 30 to 30-20 area. Any falls back towards the 30-20 area in consolidation are going to be extremely good long-term buys. Any of you who actually trade for the much longer term have an opportunity here to buy any dip towards 30-20, probably safe in the knowledge that we will trade at least 20% higher in FEU at some stage this year. Having shown you the chart of FEU, the question then becomes, how quick is that move going to be? Well, we maintain that FEU cannot move up 15 to 20% without a significant help from Euro USD, and since Euro USD is 65% of the dollar index, it cannot happen without significant downside for the dollar index. Do we see a quick downside for the dollar index? Well, no, not until it breaks this uptrend line, which has caught it all the way since the beginning of 2016. The moving averages on these weekly charts are still pointing upwards. There is a ton of support which is going to happen around the 99 area down to 98. 99 to 98 is going to be a key battleground. Only if this area here is breached can the move cascade lower and probably trade below 90. That is going to be our signal that FEU is about to explode. But for the time being, for the next 2 or 3 or 4 weeks, until we break these levels, we will be very weary. This is just the same as we have shown you in the chart of Euro USD, that 109 to 109.50 maximum should catch it for the next several weeks before the market is ready to make a move higher. This is exactly reflected, the same is reflected in this chart of DX. We have to be very patient and trade it as opposed to just position and go away. We should always have a small position short dollars and long euro just in case it breaks, but this pattern to us suggests that it's going to be a move which is going to take several weeks and several false starts before it's ready to accelerate to the downside. Gold is telling us the same thing. If the dollar was about to give up the ghost, you would expect gold to lead it to the upside. You can see how the market has been caught by these longer term moving averages, which are still bearish, and by this downtrend line. It has not managed to close above this downtrend line ever since it made the highs in 2011. But everything is beginning to point to a market which is working towards this kind of move. We think gold would definitely lead the dollar index, and the dollar index would naturally trade with Euro USD, and that would connect with FEU, with the SPY weakening against the FEU in a manner which probably indicates that SPY will do very little while FEU breaks to the upside. Why do we think all this is significant and interconnected? It is because we know that for the past several years, the big money allocators, the real money, has been very underweight of Europe and underweight of euros. They have done very well out of that. The European stock markets have been much weaker than the US stock market. The euro has been falling. Therefore, their decision has proven right. If we now are going to be right in our call that trend is going to reverse, the shortfall in euro assets that are underweight by the big allocators can probably be measured in the high hundreds of billions and probably in the trillions of dollars. That is something which is going to create a sustained trend which will last for many, many weeks and months. So we are very aware that we need to look for trigger points. We need to look for trigger points in the DX, trigger points in Euro USD, trigger points in FEU, and trigger points in stocks, and also trigger points in gold. We will be watching this trend line very carefully and examining it every week to see if we are anywhere close to breaking it and calling a move much higher in gold, which will then be the reason why the dollar and the chart of DX we've just shown you moves aggressively to the downside, which will support European equities, and FEU manages to sustain its wave up to 38, which we are calling to be the objective for this year. Well, the biases for next week finally. In the 5 and 10 years, we are still watching these triangles. We think the safest trade is still short 5 years and long 10 years. We think the curve will continue to flatten. Bunds and bobble, entirely politically driven. We think the 2-year is the area to short against longs in 10 years, and that is going to be the safest play still all the way into the French election. Unlikely to see anything from commodities for in the short term, but that will also be the interesting play if the dollar does start weakening in a few weeks' time. In the States, the equities, the third wave should be exhausted, and the retracement objectives are between 23.40 and 23.20. Put spreads, we think, short-term put spreads are still the best and safest trade here. We are neutral NQ, and we are still watching the 1346 and the 1339 levels in the Russell 2000. European equities, as we have told you, are the preferred fundamental longs over the US. FEU has the huge support around the 30-20 area, which we unfortunately don't think we will see, but any fall towards 30-20 for us is a very good long-term buy. Stocks cash 34.86 to 3500 is the upside level that we don't think is going to be breached easily over the course of the next couple of weeks. So we will be taking profits on our longs in the stocks at that level, which is still 2% away from current prices. DX, we are watching, as we said, the pattern of the retracement. If it cannot regain 102, the longer term downtrend should gather pace in the weeks and months ahead. A break of the 98.50 area, which is the uptrend line, which has held for many weeks, is not expected now, but if it does happen, it's going to have big long-term consequences. And the next big trade, which is short 2 and 5 year German and long stocks, we think is now here. The Dow Jones transports are still weaker than the S&P, and that to us is the tell of this market. There is very little upside for the S&P while that continues, and we will be short the S&P, long Europe for the next several weeks. Thank you very much for listening, and happy trading next week.